Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Joann Nevruzi and Joann Spadigam. Okay, Joann, I'm going to start with you because it feels like there's been a huge shift in sentiment over the last week, I'd say, since we last recorded. And I think one of the drivers for that was the non-farm payrolls number that we had last Friday. I appreciate that it feels like a very long time ago, but probably still the main market mover, certainly at the beginning half of this week. So perhaps you can just run through your kind of post-NFP thoughts and your take on how market sentiment has shifted since then.
It really feels like it was such a long time ago. A couple of the things I would highlight that I think are pretty important is to start with, the overall numbers showed that we added about 150,000 new jobs in over the last month, but the prior 2 months were revised down by 101,000 jobs. So another substantial downward revision in the index. The unemployment number went up to 3.9% from 3.8%. That just shows you again that metric continues to drift higher. There's a lot of these kind of rule of thumbs that precipitate recessions, like the SOM rules and whatever. We still haven't triggered those, but I think it's certainly something that will be on the Fed's radar. Additionally, you see the average hourly earnings fell back down to 0.2%. That just shows you that wage pressures are, in fact, falling very substantially measured by the survey. If anything, it's pretty much at pre-pandemic levels just by looking at where we are now. The average work week continues falling, indicating a little bit of a softness in the economy. And finally, of course, the issue of strikes. We saw that 35,000 jobs were subtracted because of manufacturing. The overall labor market has certainly cooled down, and we think will continue to do so, which should kind of tee into the Fed easing next year. Because even if growth doesn't turn around to a point where we actually have a severe downturn, unemployment in our view will still keep going up. And just because of that, the Fed should be in a position to pivot, because after all, they do have a dual mandate here, not just inflation, but unemployment too. So, and I think that's more or less implied from their quarterly forecasts, which show no recession, inflation above target, but rates coming down 50 basis points next year. So that is kind of the main reason, alongside the path of unemployment, why we could actually see the Fed pivoting faster than what markets have priced in.
Away from front ends, the other theme that's been driving markets a lot is, supply risks. And we obviously had a lot of talk around the refunding announcement on this pod over the last couple of weeks. This week, the week that we're in now, we're recording this on Thursday, we've had the first supply event since the last refunding announcement. How was that received in the market, and what does that tell you, I suppose, about the supply narrative going forwards?
People who listen to the previous weeks will probably remember my mini rant about changing issuance on a quarterly basis when it was supposed to be a little bit more predictable in my view, and against the proposal of TBAC. But nevertheless, what we had, just to kind of recap, was Treasury increased auction sizes again, but the rate of increase was smaller than what we got in August. So, for example, the 30-year bond increased by only $1 billion instead of $2 billion. The 10-year note increased by $2 billion instead of $3 billion. The 20-year was unchanged, and pretty much like that part of the curve was modified. The rest was pretty similar. And we had the 3-year auction, which was boosted by $2 billion. It went pretty well. It stopped barely through, but with the 1-issue yield. But we kind of had like a follow-on rally afterwards. Similarly, yesterday we had the 10-year auction, which tailed slightly, but we had a massive rally going into the auction, and following after that, we continued to rally. So overall, the supply has been digested pretty well. We are in about 3 hours, we will have the 30-year bond auction, so I can't really comment for that. And markets have, we have had a little bit of a concession in the long end, but we will see how the auction behaves. But like I said, I don't think it's that worrying. The whole supply adjustments shouldn't really lead to these like big rallies or sell-offs. And if we're right in our forecast, Treasury actually will not be able to stop increasing in February as they intend to do. In fact, we see them going through February and also May afterwards, which might resurface these supply worries next year if it calls a rally to this magnitude. course, positioning is always a big factor in these sharp moves in either direction. But if people are expecting that February will be the month where we stop increasing auctions, I think I would like to take the other side on that, and kind of go into a year where deficits might increase, and generally either we will have to see QT stopping, or not our base case, issuance shifting massively to bills, also not our base case, although we see positive bill issuance, or the fiscal or the deficit somehow narrowing through either higher taxes or lower spending, which certainly is not my base case. So it'll be like an interesting dynamic to see how markets absorb it in February.
Adjustment.
But other than that, it was a relatively slow week in the US as far as data. And even though we had some Fed speak, it wasn't really anything out of the ordinary. So with that, I'm going to shift back to the UK. And we had a substantial repricing of substantial, a rather large repricing of the front end, which has been kind of moving the rest of the curve as well. So I can talk to us about a little bit what happened there.
Adjustment.
Yeah, I guess it was, like you say, the sentiment kind of shifted, starting with the NFPs last week. And then we had some comments from Hugh Pill, the Bank of England's chief economist, at the beginning of this week, which helped that to kind of continue really through the whole week here in the UK. I guess, I would start by saying that regular listeners will know that, it's long been our base case that the market hasn't been pricing enough in terms of the kind of BOE easing cycle next year, both in terms of the scope, but also in terms of how early that easing cycle might come, relatively speaking. And so the market has gradually been shifting in our direction, so to speak. But I'm a little bit surprised at, how quickly that has happened, but also how it seems to have happened on not a huge amount. Listeners from last week's pod will remember that I thought that for all the kind of dovishness of last week's Bank of England meeting, there was sort of equal and opposite hawkishness as well. And perhaps even, you could find more hawkish elements than dovish elements. So, and I think the point there that I would highlight, and that I think is really worth remembering, is that the MPC last week kind of implicitly endorsed market cut pricing, given the way that their projections evolved on the market rate assumption in their forecasts. But that cut pricing was much more hawkish than what the market is currently pricing in. And I think it was interesting that today's comments from Pill, so on Thursday, he sort of leaned, although I don't think in either sets of his comments he's kind of necessarily shifted from the party line. I think he leaned more heavily on emphasizing the more hawkish elements of the MPC's recent communications rather than the more dovish elements today. So perhaps a little bit of pushback against what we've seen in terms of market repricing over the last couple of days. But like I say, our long held view has been that the market needs to shift more and, to price in more of an easing cycle. We think they cut 100 basis points next year. And even with the repricing that we've had, the market's still only pricing 75 bips. So I still think there's further to go. I still think cuts could come earlier than the market is expecting. But I just didn't expect it to reprice perhaps this side of Christmas, let's say. The other 2 points that I would make just about the recent repricing and bank rate expectations. The first is that I think it's interesting that in the UK that has come about without really a shift in terms of inflation expectations. Now, of course, you wouldn't necessarily expect that, one or two earlier cuts in bank rate would necessarily have an immediate impact on the RPI profile. But you might think that, the market would have to price in a lower RPI profile in order for the bank to get 2 cuts. So I think there's a bit of a juxtaposition there between what the market's saying on the bank rate side versus what it's saying on the inflation side. And the other thing that I think is interesting is just the way in which the longer end of the curve has traded. So although we're now pricing in a much kind of deeper cutting cycle, if you like, next year, if you look at something like 10-year gilts, for example, you're still only at the bottom end of recent ranges. We still haven't broken out of that range. And I guess that's been a key call for us recently, although we have had a kind of fair value target that's been at the top end of recent ranges. Breaking out of this range of this kind of 4.2 to 4.6% range is going to take something more meaningful, I think, than just some slightly dovish comments from Hugh Pill. We're going to have to see a more meaningful shift in the data and central banks globally, I think, shifting away from this restrictive for longer mantra, which we just aren't seeing yet. So I know we're going to be recording a kind of year ahead special of Bondcast, so I don't want to steal the thunder of that next week, but I guess just as a slight preview, our call for next year is that we think, although we see a deep cutting cycle, the supply narrative will still weigh heavy at the end of the year, and therefore you don't get as big a fall in kind of longer dated yields that you would usually expect with, let's say, 100 basis points of cuts on bank rate. And I think the market is kind of reinforcing that view this week.
Outside of supply, there's also a lot of data coming up in the UK, and it should be pretty big overall for like new economic news. From that perspective, do you think we'll get another shift in bank policy rate expectations?
I think the short answer is it's possible. It is the big data week next week. So we get the inflation data, the labour market data, retail sales, I guess, are the highlights. I mean, naturally, you would think of inflation being the highlight within that group of data, but particularly in the UK, given the problems that we've had in the recent labour market data prints, then clearly I think inflation will weigh more heavily in terms of shaping bank rate expectations going forwards. And certainly that's where we see the kind of biggest shift in the data. So we see headline and core both coming off next week, but headline will see a much bigger step down. We have it coming off from 6.7 last month to 4.8. So clearly a big jump. Now, most of that should already be in the price. It's largely a kind of mechanical shift lower from lower energy prices and the quarterly reset for the Ofgem cap, which takes place in October, kind of driving energy prices down. So it's well telegraphed. The BOE have spoken about it before. Governor Bailey has said about the big drop that they're expecting in headline, but of course a big step down like that doesn't harm their narrative that they've probably done enough on the rate side. And certainly when it comes to the market, it feels to me, given the way that sentiment has shifted this week, that this is a market that's more biased to reacting more strongly to kind of data that confirms the view that the end of the hiking cycle is in and that cuts are on their way, rather than the other way around. So although that big step down in inflation is already telegraphed, like I say, it's kind of a mechanical step down, it's not on kind of core services inflation. I think that that will clearly be welcomed by both the market and the BOE. It's still our base case that the near-term risks to inflation are skewed to the upside, particularly as we head into Q1. You obviously have a lot of backdrop of geopolitical uncertainty, and then we have the whole kind of wage setting round in Q1 in the UK, and we think the risks there are skewed to the upside. And in fact, maybe the market is, given the repricing that we've had, perhaps the market is underpricing the kind of upside risk to bank rate in Q1. But I wouldn't necessarily overstate those upside risks. I'd pencil in maybe kind of 20% of another bank rate hike in Q1. But I still think that's the way that the risks are skewed. But overall, it should be a favourable print, I think. And like I say, with the kind of difficulties, let's say, of the labour market data that we've had in the UK, I think the market largely dismisses that in terms of a signal for the monetary policy reaction function. We will, of course, get average weekly earnings as usual, but the MPC themselves have kind of talked down the importance of average weekly earnings, given the difference in trend between that official data and what the survey data is showing us.
That all makes sense. And maybe I should have asked this actually as we were talking about supply, but now with the Bank of England behind us, well, central banks behind us for a little bit, we get a little bit of a reprieve until December. But I guess markets will focus on the autumn statement that's coming up later in November. What should we expect from that one?
Yeah, so we're just sort of starting to put projections together for the autumn statement. So I guess the key takeaway for markets is that we think that the revisions to the gilt remit will be lower than what the current kind of undershooting in the borrowing data suggests. So what we've seen, we have data for the first 6 months of the fiscal year in the UK, and what we've seen is a big undershoot in borrowing versus expectations, which has largely been driven by higher than expected receipts. broadly as a function of inflation being higher. So if you were to extrapolate the trend that we've seen over the first 6 months of the year, you might get a borrowing undershoot that would look something like 20 billion, let's say, for the full year on CGNCR, the central government's net cash requirement. We think it could be much less than that, partly because the undershoots have already started to diminish, and we think that that will continue, as the growth backdrop weakens, but also as inflation comes off. Partly because the OBR will also be refreshing their economic projections, which we think are likely to be revised down versus what they had in March. Partly because debt servicing costs, or their projections for debt servicing costs, will have to rise. That debt servicing cost number also partly includes the cost of QT, as we've talked about a lot on this pod before, which is currently higher than expected. And partly because some of the fiscal headroom we expect will be used up in kind of pre-election giveaways by the incumbent government. Now, we expect most of the bigger, probably more costly measures to be reserved for the spring budget, which will be closer to the election, which we think will be in autumn next year. But there will be a little bit of recycling of a headroom in the autumn statement. So we pencil in a kind of revision to CGNCR somewhere in the region of kind of 5 to 10 billion, a revision downwards, that is, which, when we're talking about gross issuance of, just shy of 250 billion, a reduction of 5 to 10 billion feels like not much more than a rounding error, really, and doesn't change this kind of overall narrative that supply is going to be very heavy, and the market, we think, will struggle to absorb it, certainly at lower yield levels. In terms of the remit itself, I think we could see another marginal shift lower in terms of the duration of the issuance. So the DMO might opt to increase issuance in the shorts and mediums buckets and away from the longs and linkers, just really in response to kind of a lack of demand at that part of the curve. That's a gradual shift that we've already seen happen over the last few fiscal events, and I think will continue to happen kind of through this autumn statement and the spring budget as well, which supports our view that supply going forwards, we think, will weigh heaviest on the belly of the curve. But we still have a few weeks ahead of the autumn statement, so I'm sure we will come back to that over the next couple of weeks. Joann, let's shift gears and move over to Europe, where, again, we've had a kind of shift in sentiment, a repricing of rate expectations. Markets are now pretty close to our base case of pricing in 100 basis points of cuts. What do you make of that shift in market sentiment?
So European rates have kind of moved along with this global dovish or bullish shift. And markets pricing in, like you said, very close, around 97 basis points of our 100 basis points for next year. I think given that we've seen that the ECB has called the end of the hiking cycle a bit more clearly than the Fed and the BOE, that this kind of repricing does potentially make sense. And I think the data is coming on side with growth and inflation as well. We had some comments from Vilward this morning, really the more median kind of ECB member, noting that the risks to an upside skew in hikes is fairly limited, unless it's another external shock. So I think this kind of end of cycle theme is more ripe in Europe with what we're seeing in the data and from the ECB specifically. So yeah, markets are pricing in very close to our base case for the year, but we do maintain our expectation that we could potentially see rate cuts coming in sooner than the market has priced in for March 2024. And I think the market is slowly coming on side with that in terms of pricing, looking more like a third chance of that happening. So our kind of more near-term cuts bias does remain, and potentially we also like being long the back end in the reds, really. So getting the story where we actually might see cuts coming in even further than markets are priced in at the trough. So markets pricing in 275% for the end of the hiking cycle versus our expectations of 225.
The other part, I suppose, of ECB's policy normalization over the next year or years is on the balance sheet front. Now, that's obviously something that we've written about, we've spoken about a lot on this podcast, but I guess a less talked about part of that is this kind of review of the operational framework that they'll be undertaking as the balance sheet shrink sufficiently such that they become worried about the kind of supply of reserves in the system. Schnabel has previously kind of offered her opinion on what the outcome of the operational framework review should be. And this week, I think we had some comments from Chief Economist Lane as well. What are your takeaways on his thoughts?
There are broadly two kind of schools of thought coming from the ECB based on what Schnabel said in the past. The first is that they could use a small Bank of England style approach, where really banks are able to demand as much liquidity as they want from the central bank, and the central bank kind of provides that liquidity via repo operations or short-term liquidity operations. And the second is more like the Fed has, where the central bank has this right or can shrink the balance sheet up to a certain level, but that level will be determined by the demand for reserves. And it seems to be the case that Schnabel prefers the Bank of England style system, and Lane's comments very similarly point or suggest that that could be the option that the ECB does take forward. There's not been too much chatter on this of late, so I do think that Lane's comments are particularly important here, because it does confirm the story really that the ECB might move to this Bank of England style reserves framework that should come to pass or be talked about a bit more in the spring of 2024.
And finally, I guess partly as a result of the shift in sentiment and the repricing that we've seen in kind of bank rate expectations, we've obviously seen a shift, well, not obviously, but we have seen a shift in BTP Bund spreads as well. So they're back down to, I think, probably close to about 185 basis points as we record. What's your take on that? And do you think that this tightening, I suppose, persists going forwards?
BTPs really seem to be trading with a beta to outright duration. So I'm not surprised that this bullish move we've seen has also meant that BTP Bund spreads have tightened. But I do think that what I remain concerned about going forward really is this announcement effect from PEP. And I mean, it's not been discussed recently, but I do think it is coming. And that in itself should, I think, bring a bit more of a wideness in the spread. So I think in the short term, I am still biased towards wider BTP Bund spreads. 210 is still kind of the target here. But I think once the PEP story is complete and once we have an understanding of what the ECB does plan to do in terms of PEP, there could be room for BTP Bunds to tighten once again. But for now, I think the near-term risks are skewed towards wider spreads.
Okay, sounds like something we might pick up in a bit more detail in our year ahead special Bondcast next week. So it's just a reminder to all of our listeners that we will be recording a special episode next week that runs through all of our year ahead themes and views in detail in conjunction with the publication of our year ahead 2024. Okay, that's enough for this week. Thank you both for joining me. Thank you to our listeners for listening in. And just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.